Hello, YouTube. The stock market is now starting to price in a soft landing or the Goldilocks scenario. We can see that here by the third consecutive week where we have lower wicks or dip buying, and the S&P 500 managed to close above last week's high and the high from 2 weeks ago by closing above 388. Jerome Powell is going to be talking on Tuesday. So is this the Goldilocks soft landing report? Let's see what Jerome's going to tell us on Tuesday. There is a lot for us to go through. As we're getting started here, there's not just one sector that's doing well. It's actually pretty broad-based. S&P is doing good, but you might not have actually known that China actually went up nearly 10 times more than the weekly gains on the S&P 500 by closing out by 10.3%. There is a lot for us to go through this weekend. So as we're getting started, if you could please smash that thumbs up, I would greatly appreciate it. All right. So as we noted at the top, there is some progress being made. We note a hammer. We are closing near the high of the week, which usually implies we're going to go higher. In the stock market, the saying is that it is okay to it is okay to be wrong. It is not okay to stay wrong. And I thought we were going to go lower on Friday. I was wrong. That's okay. We're going to recalibrate. We're going to reposition, and we're going to get ready for this next week. So at a very high level, I'm watching Jerome Powell on Tuesday, and we're going to take a step back a little bit later to understand exactly what happened on Thursday and whether or not Jerome Powell is going to, number one, take a victory lap on Tuesday, or number two, tell us that there is more work to do. I think that whatever happens into the first half of the week is going to be the opposite into the second half of the week. And the reason why is because we got two really important data points. We got Jerome Powell speaking on Tuesday at 8 a.m., and he's going to pretty much tell us, was it a Goldilocks market where it's neither too hot or too cold and the economy continues to create jobs while wage pressures ease? Or is he going to say the same thing every other Fed official said this week, where we got more work to do, we got to keep rates higher for longer, and instead of telling Jerome what he's going to say, let's see what he tells us. Note, this is going to be pre-market on Tuesday. So if you're holding overnight on Monday, you're going to be holding on through Jerome. And then we got the Super Bowl of data. We got the CPI print coming in on Thursday, and we're expecting it to come in below 7%. I think the market would cheer that if that's the number that's going to be reflected. So anyways, let's jump forward here. We also note that fear and greed is now back to neutral. So we went down into fear. We're back up to neutral, which means that there's a push-pull happening between fundamentals and technicals. Let's have a look at a few more charts here really fast to get a sense of what is actually getting priced in, because the market is agreeing with the soft landing. S&P closing up by about 1.5%. The NASDAQ, or QQQ, closing up by about roughly 1%. Let's just call it 1%. Dragonfly Doji. Shifting gears here to the dollar, we note that we're still trending up. We did actually get an inverted hammer, though, which is usually a reversal pattern. If that reversal pattern leans to more, sorry, I can't talk right now. We're going to lose this green uptrend, which means we're going to fall back below 102. And I would say there's confirmation by getting back below about 100. We look here to VIX. Well, it's right on the week. Almost a bearish engulfing candle. We're down by about 2.4 and down to the low 20s, which means the market is calm, cool, tranquil. There's nothing to worry about, and we don't have to buy insurance. The house is not going to burn down. Looking here to the 2-year note, this is really notable. Why? Well, we're stopping to trend up. It's not confirmed yet. We're going to see what happens next week, but opening up flat would mean that we've actually stopped going up like we did all the way back to 2021. Is this accurate? Is it going to hold? I don't know. But as of right now, what I can tell is that we've stopped going up. And now the question is whether we're going to go sideways, whether we're going to go down, or if we're going to resume back up higher. Again, I think a lot depends on what Jerome Powell has to tell us. We look here to the 10-year note, right back to support, right back to roughly 3.5, right back to our uptrend. Same note here. It's down by 8% on the week. That is very, very notable. If we look here to inversion, which means the 2-year note over the 10-year note, it's actually taking a leg higher. So that is a recession signal, but we'll talk about recession a little bit later in the show. And as we go through here, let's just jump to so when we talk about the 10-year note, this is pretty much what is going to be qualified for technology stocks or growth stocks to go up. So with this huge decline, what I don't really see is tech getting strong. That is what's really missing for this recipe. Most other ETFs are strong. We reviewed those last week. We will review them at the end of the show as well. So if the NASDAQ is truly going to go higher, well, why is it not? We got 4 consecutive weekly closes below the 200 MA, which means we're kind of soft. And we note here on our monthly chart that we are still below our 50 monthly. And the only previous time this has happened goes all the way back here to 2008. So History does not repeat itself, but it often rhymes. And as of right now, this still rhymes. What we did talk about as well, though, is that we have to print a monthly lower low for QQQ to confirm we're taking a fresh leg lower. Has that happened yet? Answer is no. No, it hasn't. So last month, 25973. Here we got 260.34. It saved it by a whisker as of now. But we have to rally up by about another 1.5% for us to reclaim that 50 monthly at roughly 273. In addition to that, we also have a really important area here on the 200 weekly, currently at roughly 280. So we have to rally up here by about, I think it's like 4 or 5%. So roughly 4 or 5%. Yeah, about 5%, call it that, for us to reclaim the long-term price on the weekly chart. That's going to be a repeat of Friday times 2, which means we need 2 days like we got on Friday, and then for us to tread water. That's what we need to see. Other thing I would notice that on the daily chart, we also have the 50 MA coming in here at roughly 277. So 10 points higher. This is where the true test is going to come in. And last thing we're going to look at before we try to dig a little bit deeper to look at all these fundamentals is the S&P. So there was some significant progress made, as I noted earlier, because on SPY, what was resistance, meaning, let me actually just get nice and close here. When we look at the last, a little bit closer for those boomer eyes, again, if you wouldn't mind, please smashing that thumbs up. I would greatly appreciate it. You can ravage it. You can click it multiple times. You can smash it or do whatever. Please just click it. I would really appreciate it. Also, let's look here to the S&P. And as I noted, we have 2 key areas here. We have the last week high at about 384 and the previous weekly high at 287.41. What did we do? We closed over both on a weekly candle close. That's pretty bullish. So if this is bullish and it acts as support, if we do backtest, I would expect to find support at 387 and 385. Again, expect, not guaranteed. Before we get to 390 and higher, we have to battle with this 50 DMA on the SPY, which means we need to get above 390. So as of right now, we've now roughly hit that 50. And now the question is whether we're going to pivot higher, meaning we're going to actually take a leg up, or if we're going to take a leg down. Because of the timing with Jerome Powell speaking on Tuesday, I think we need to just be mindful that let's not front run this. Why? Well, let's be a little bit objective here. Let's delete all the lines. And I mentioned this before. I think that the gains from the bulls are encouraged. We do see increasing price with increasing volume or heavy accumulation during this period. And we're right here at the 50 MA. We're still in a bearish pattern. We're still below moving averages. We still need more progress, period. That's what we need. We've been talking about for a while that the coil is getting tight. Well, it decided to explode. And I think that the data point which actually drove this price action is not the one I was expecting, which means the market is a fluid moving market. You got to be like water, as Bruce Lee says. You got to be able to move and ebb and flow with what the market does. Now let's dive a little bit deeper into what we're expecting for this week and see if the big man himself is going to blink or take a victory lap. So a victory lap would be that he says this is a Goldilocks market. And before I go further, I forgot to mention that right now we're pricing in either a 50 basis point hike at the February 1st meeting or a 25 basis point. Right now, the market is pricing in roughly 36 basis points, which means it's about 50-50, whether we're going to go up by 50 or down by 25. That's what it comes down to. They're still going to hike. And I think that what Jerome says on Tuesday is going to give us more of a confirmation. And then we have about 3 weeks until the end of the month for us to trade, which means if we're getting a change in trend, let's be very mindful of it. All right, so it's neither too hot or too cold with the economy continuing to create jobs while wage pressure eases. Let's look and see what exactly happened. This is what everyone's cheering. Oh my God, we went from 4.8 to 4.6. I don't know that that's all really that impressive. Is it encouraging? Sure. If we look at this chart, what do I see when I first look at it? I see a bullish pattern. I see inverse head and shoulders. So yes, we are ticking lower. Is this really a significant trend though? No. We're basically just coming back to where we were in 2020 at about 4.6. What do we need? We need it to go even lower. And this is not really the most important data point. So for me, again, this is the reason why the market went up. So it doesn't really matter what I think. The news versus the reaction to the news. This is what caused us to go higher. It ticked down to 0.2%. It's not impressive for me. But that's what the market decided to go higher on. So we have to be mindful of that. So is Jerome going to take a victory lap? Or is he going to say, actually, there's more work to do? I know exactly what the Fed is looking at to achieve this year too. It is PCE, it is inflation, and it is the labor market. So if we have a little bit of a cheat code for what we want to see Jerome Powell mention a little bit later this week, this is a cheat code that I shared with our private group, and it's these three simple things. It is moderation in goods prices. That's CPI. We get that report coming out on Thursday. We need a moderation in services prices, which is excluding housing, or the PCE, which is what the Fed cares about. And we need more slack in the labor market. So we got 1 out of 3. Is the market front running this? I don't know. Let's see what Jerome has to say. All right. So with Jerome speaking here, and we got CPI, that's really what's important to me. Let's just see what Jerome has to say, and then we'll go from there. So let's try to get a little, let's go back in time and see actually what these data points were. So if we go to this week, we had a jobs, again, keeping in mind what I just told you regarding those 3 points the Fed has as a mission for 2023. JOLTS job openings means we actually got a 5% bump. Previous report revised higher. So there's more job openings. There's not slack in the labor market. That's bad. Fed meeting minutes, there was consensus. Higher for longer. Okay, cool. ADP non-farm payroll, beat. Revision, beat. Initial jobless claims, beat. Revision, beat. Non-farm payroll, beat. Previous number revised down. And unemployment, beat. Revision, beat. That's not really what the Fed wants to see. But again, let's see if Jerome takes a victory lap. He might want to. If he does, great. Market's going to go higher. If he doesn't, I'm not sure what's going to happen. Here's what I'll say, though, too. I forgot to mention this at the outset. Whatever happens into the, I think I might have, first half of the week, I think the opposite will happen into the second half of the week. Meaning, if we go down on Jerome, I think we're going to go higher into Friday when we got that CPI print and earnings kicking off on Friday with big banks. If we get a move higher in the first half of the week, I am less confident about the second half of the week. I'm not sure we're going to go up and then more up. I could be wrong, but again, I would feel more confident if we get some kind of a back test into Tuesday, meaning back testing either 387, but maybe even ideally down to like 385. So we can confirm that before we advance, that 380s are actually support and not resistance. Or we got to blow through that 50 DMA, and that should become support, where we can make a march towards 400 and our 200 DMA here. That's what we want to see. Roughly 400 get claimed if there's going to be a power up from here. All right, moving forward. Weakest payroll gain in 2 years signals easing job market. Unemployment rate matches 1960s low with more joining workforce. So I just want to spend 1 second here talking about this. So why would wages come down, but really only by about 0.2%? I'm going to defer to someone smarter than me, Larry Summers, who I watched an interview on over the weekend, and he said that it's probably because younger people are coming into the labor market who work for what? Minimum wage, which means what? Less inflation on wages. So if young people are coming into work, but we had 10 million jobs open, does that mean that old people are never going to come back? Yes, that's tightness in the labor market. So again, Goldilocks, not too hot, not too cold. Market liked it. Let's just leave it at that. Moving forward, here is the part that's super, super interesting. U.S. services gauges shrink unexpectedly in worst slide since 2020. So this is usually good for stocks because red is good, meaning a miss is good. Let's now look at SPY and note the time this data point actually came out. So we look here to Friday. ISM non-manufacturing came in at 10 a.m. It also came in with a red number below 50. Below 50 means a contraction, where we're doing less. We're not growing. We're shrinking. So what does that mean? Well, it means maybe the Fed's done their job. That's what it means. A soft landing, not too hot, not too cold. And normally this is the more important data point. But again, let's look to the chart here on Friday to see when that power up really started. 10 o'clock right on the dot. Yep. As soon as the 10 o'clock hour opened, we closed here at about 380, open up, and then we rallied up 8 points nonstop. That is nearly a 3% move, right? Woof. That's right. Woof. So we look off the low here. We rallied up by about 2%. My apologies. It's four points per 1%. Right. My math is not exactly up to snuff today so far, but there we go. Nonstop up. And we moved higher over every resistance area, right? Pop flag, pop flag. So if we're going to continue higher, we have to be receptive to the reason why we went up. It wasn't jobs. It was CPI. And remember, I just showed you the Fed has already pretty much claimed victory over CPI. So instead of me telling you what's going to happen this week, let's listen to Jerome. We already know this has happened. So I would feel more confident If Jerome takes us down into the first half of the week, and then we rally back up on that CPI print coming in good, that's still only 1 out of 3, though. I really want to focus on what Jerome says about PCE or services inflation, and also labor market participation, or if there is slack in what he is saying. Why? Don't fight the Fed. And Jerome's going to tell us what to think. That's what I believe. So this number here is really important because ISM is usually going to feed through to CPI. Producers produce, and then consumers consume, meaning they buy. So you got to produce things before people can buy it. That's what it comes down to. This is the other thing I'm really going to focus on for Jerome. I want to see whether or not he tries to tell us that we need to go higher for longer. As of right now, there are 17 out of 19 Fed officials, which pretty much means consensus. Let's just type it up here. So we got 17 out of 19 Fed officials who say, man, that's really typed up terrible. Let's do it here. 17 over 19 Fed officials, or 9 out of 10, which are saying that we need to keep rates over 5% for the entirety of 2023. Okay, so we got to get to over 5, and then we're going to stay there. Well, they're pricing in like almost 50 basis points in cuts through to this time next year. If that's wrong, I think Jerome's going to tell us. And I also want to keep in mind that maybe I was wrong about us going lower into the first half of the year. And I'm going to defer back to what we talked about at the end of 2022, where 3 out of 4 times when we have a bearish engulfing annual candle or 12-month chart, we've gone green the next year. So odds are that we're going to go higher. We have to be very mindful of that. Second thing is that if we are going to get a red year, it's usually going to be a nasty one. Like what? Like 1973. And we're already comparing to 2008. So the fact that we're green into the first week of the year, it pretty much tells me that maybe we're going to go green. So I'm putting my thinking cap on, critical thinking, and asking myself, how could that happen? Well, I could see that happening here where we punt or defer the recession to the second half of the year. Here we're looking at the St. Louis Fed GDP Now tracker, which shows us that the Q4 GDP for 2022 is going to come in at 3.7. So Q3 is 3%. Q4 actually grew more, 3.7%. That could be bullish for earnings kicking off on when? On Friday. So we have earnings kicking off on Friday, getting into the thick of it, starting into like the following week. And then big tech, I believe, is near the end of the month. And we're going to talk about that a little bit later. But going back to here, what is a recession? A recession is defined by 2 quarters of negative contraction on a year over year, which means, oh man, that's typed up terrible too, right? I must be a lefty. That's right. I am a lefty. Year over year. So if we're trying to think about a year over year, when we're comparing Q1 of 2023, we'll be comparing it to growth of 0.37%. I think we can probably beat that number. Why? Well, look, we're increasing here. It's a Fed-induced recession, which means we're probably going to come back down to like, I don't know, like 1, 2, 3, something like that. That'll beat Q1. Looking at Q2, hey, if we get less than negative 1.1, that's a beat. So how are we going to get 2 negative quarters? Well, that's where the problem comes into Q3, where we're going to have to grow by more than 3%. And then into Q4, we're going to have to grow more than 3.7%. And the Fed says that there is a lag in effect between them hiking rates and the economy actually feeding through to it. So what does that mean? It means that they've been tightening for some time, and we can look and see when that started. It started here in April of 2022. So for the full cumulative effect of these rate hikes, we're probably not going to see that until later, which means I believe now that we're going to have a recession into Q3 and Q4 of 2023, or we will get confirmation of it into January of 2024 when those numbers are reported. Again, a recession will be confirmed when we look back in time and have 2 times quarters of negative contraction. So I don't think we're going to get that in Q1 and Q2. I think, again, not I know, I think it's going to come into the second half of next year. This is what I really want to focus on and what Jerome's going to say as well. Why? Because the Fed wants to hike more as the economy is growing, so that when it starts to have a hard time, they can pivot. Like what? Like they did in 2008, 2007, 2008. Oh, that was a recession right here. Yep. The gray area defines a recession. So they jack it up, they hold it flat, and then they cut rates into the recession, just like they did in 1990, just like they did in 2000, just like they did in 2008. But note here, they started jacking up rates in 2006. It took almost a year and a half to 2 years for the full cumulative effect. And We note here that they held rates from roughly August of 2006 to about August of 2007 flat. That's 1 year. That's the disconnect right now with the Fed. Why? Recency bias. The market's looking to 2018, where we peaked out here in roughly January, and then we don't really go anywhere until about August. That's only about 6 months. That pretty much is what the Fed is pricing in. Sorry, the market is pricing in right now, where we go up, and 6 months later, we're already cutting. So is that right? Well, I don't know. I think the market is trying to front run the Fed. So let's just make sure we listen to Jerome. He is the big man. All right, a few more things to look at here. We talked about tech, and we looked here at our chart, and we noticed it's lagging. So just before we look at the options, because, oh my goodness, are there puts coming in for options on tech? I want to compare us to, let's actually have a look here at the trillion-dollar companies really fast. And we can note here that failed breakdown versus 126 on Apple looks constructive if we don't look back from here on a 12-month chart. We've now recaptured the 2022 low. That's important. Moving forward here in order for largest cap companies, Microsoft down by 3.6. Chink in the armor. Let's pay attention to it. Pay attention to it. If it can't push off the 200 weekly here, it might add more pressure. There's already bearish volume here. Moving to Google, already below the 200 for 1, 2, 3, 4, 5 weeks in a row. That's not good. Amazon, man, nasty. They're laying off jobs. Bullish engulfing candle. Let's see if it turns into more. NVIDIA, trying to bounce off the 200. Let's watch. There's a inverse head and shoulders. Inverse head and shoulders pattern that's forming here on NVIDIA. And I'm noticing that same pattern on a lot of stocks, including QQQ. So if this holds here, again, it's a bullish pattern. Let's watch and see what happens. Tesla, failed weekly breakdown. It's still below the annual low, though. Let me just double check. Actually, no. Over 108, we're back below the 2022 low. And that might be a failed breakdown. Let's pay attention to it. Tesla is like a really good sentiment gauge. Worst week, worst month, worst year on record. Let's see if a dead cat bounce can lead to a potential reversal. Meta, running the downtrend here. It's just the lowest PE stock. I think it's about 11 compared to 20 plus for every other company, which means people are buying up value. That is the theme of 2023 so far. It's not tech. Look here. Let's just move forward to the rest. And I do want to talk about FXI in a moment, but Dow bouncing off the 50 looks constructive, much closer to all-time highs than not. Even with Microsoft in there, it's still powered up. RSP over the 50 weekly. Okay. NYA over the 50 weekly. Okay. IWM up 1.8 on the week, outperforming S&P, outperforming the NASDAQ. Okay, interesting. Bouncing off 2018 and 2020 highs. All right. Looking here to XLF, which banks are going to be reporting starting on Friday, over the 50 weekly, 3.5% on the week, rallying into earnings. Looking at healthcare, red on the week. People are just rotating, watching this closely. There's also some news out of China, which I'm watching pretty close because this tells me that they did not want to do this, but now they're going to have an American product going into Chinese arms. That's kind of a big deal. And I'm not sure why healthcare is lagging on that headline. It's kind of a big deal. 1 billion plus people are going to get them. Energy, green on the week, but only 10 cents. And oil was actually down pretty dramatically, which actually gives us growth concerns, right? So growth concerns, but a lagging effect. Let's see what happens. Moving here to utilities, we are now throttling the 2020 high on the 50 weekly, and I think we're just over it. XLK up by 0.23, not over the previous weekly high. It's bouncing off the 200. Let's see what it's got. Again, that same pattern here, inverse head and shoulders. Looking here to ARC, green, but only by 0.42. Again, heavy weighting on Tesla for the stock. Moving here to FXI, this is where I think US tech is going to have a true contender with yields being down dramatically this week. Tech should have been up a whole lot more. It was up strong on Friday, but we need to see continuation. Why? This is telling us that stocks in tech should be up a lot more. I think that people are actually selling US tech to go buy Chinese tech. Why? They're way down in the dumps. So that's why I believe FXI is up by more than 10%. We know China wants to reopen. They're easing monetary policy. They need to grow. They're kind of desperate for growth right now. So with the US raising rates still and China easing, there's a flight of capital from America to China. And that's really what I think the story is here. We can also see that pretty obviously here by looking at EEM or emerging markets, which are currently up by 5.7% on the week, or right? Let's go here. Let's do a little bit of quick math. 5.7 divided by 1.5, or roughly 4 times more, which means emerging markets are up 4 times more than S&P, and China or FXI is up by roughly 10 times what the S&P is up. So if you like making money, well, FXI basically just returned an annual return for the entire year on the S&P in one single week. Oh, wow. Again, one more time. S&P normally goes up by 10% in an entire year. FXI went up 10% in 1 week. Whoa. So that's part of the reason why there's pressure on tech stocks. Another reason why there's pressure on tech stocks, let's go back to December 1st to roughly today on Jan 7. Let's look at our put call ratio, 1.75, which means there are roughly 18 million puts bought, over 100,000 in premium, compared to 10 million calls. So now pay attention to one more thing here, because for this next week, after Jerome speaks going into OPEX on the 20th, and then the Fed meeting on the 1st of February, when do most of these large contracts expire? On January 20th, Jan 20, Jan 20, Jan 20, Jan 20, Jan 20. They're really concentrated on Jan 20, which means they're looking for a push lower right into Jan 20, period. What are they betting against? They're betting against SPX with 23 billion, QQQ with 4.5 billion, and not really all that bullish on the call side. SPX 4 billion, more bullish on SPY here, but 18 billion puts on Tesla compared to 1 billion in calls. That's an 18-to-1 put call ratio. Amazon 5.5 billion compared to 200 million. BABA 4 billion. That's what's happening here. It's Tesla, Amazon, QQQ, and the S&P 500, which are getting bet against. So there's a deluge of sellers on tech. There's no more TINA, right? TINA means there is no alternative. Right now we're calling it TARA, meaning there are reasonable. And I really can't type today. I'm left-handed. All right, TINA, TARA. There are reasonable alternatives. There are reasonable alternatives. Yes, there are, including gold, which is up more than 2% on the week. So if tech cannot get some lift this week, we have to remind ourselves where we are. We are below the 200 weekly. We are below the 50 monthly. And that's really the story for us this week. Let's make sure we don't forget it. Final thing to look at here is that banks are going to be kicking off on Friday with Bank of America, United Health, JP Morgan, Delta Airlines, Citigroup, and Wells Fargo. I just want to briefly look at these earnings to see what they're forecasting here, because we noted XLF is going higher. So UNH, one of the largest stocks in the S&P 500, which has had a really rough start so far this year, looking at year to date, UNH is down by 6.7%. They're expecting a beat. Let's see what the result is. Sorry, the reaction. Looking here to JP Morgan. We're looking for a beat, marginal beat, not very big. All right, let's look at Citigroup. Citigroup is expecting a beat, 5 cents. Cool. Let's have a look at the next one here. BlackRock. BlackRock, 798 over 784, marginal beat. Other ones we got here are Wells Fargo, WFC. Not available. Okay. And the last one here we want to look at is, did we look at Bank of America? Let me just double check. I don't know if we looked at BAC. 85 cents over 81. So I think it's really going to come down to the first half versus the second half of the week. And as I mentioned, I believe that if we go down into the first half of the week on Jerome, I believe we can have a more sustained rally for the second half of the week. So with that said, I thank you so much for watching, and I look forward to seeing you on the next video. If you haven't already, I would really appreciate if you could smash that thumbs up. And if you want to come join me, Justin from YouTube, you can join us for a 14-day free trial to see how I'm going to take all of these notes, formulate a plan to try to beat the market next week. Thank you so much for tuning in. I look forward to seeing you on the next one.